Ladies and gentlemen of Germany, it's me, NYSEinstein from the floor of the New York Stock Exchange. Still feeling a little bit under the weather, but I came to work. Powerful day, a lot to say. Anyway, this is the wrap. Okay, in December, we raised rates finally, way overdue, and the market wasn't taken by a storm. People were on both sides of the trade. Net, we did it because they felt that the economy was in good enough condition that we needed to raise the rates to get back in some kind of flow as far as banking goes, as far as rates go, as far as basically stop lending money for free and raising some revenues for the government at that point. Okay, I feel it happened a bit too late. It showed a lot's happened since January 1st. A lot of it, I believe, had a lot to do with the raising of the rates way too late. It was the end of the year. It was all the hedge fund action, all the world geopolitical stuff going on, and people closing out positions, closing out funds, and whatnot. But it didn't give enough time for the market, once it did that, to really react and to get itself back fitting into some comfortable close again. January 1, we started. We've had an absolutely ruthless 6 weeks, first of 2016. Market sold off radically. A lot of it to do with the Fed funds, the Fed rate, in my opinion. A lot of it, obviously, to do with the oil trade. A lot of it to do with China and whatnot and what's going on in Iran and Saudi Arabia. 6 weeks of sell-off, whether it had something to do with people's posturing on the Fed or not, I'll leave it out there into the marketplace. February 11th, bottom. Bottom in oil, bottom in the market. March 11th, rallied back 10%, okay? Fed meeting today, okay? People's anticipation. We've always said that the decision to raise rates further or lower them would be data driven, meaning that if they felt the economy was dealing with the last raise enough and a comfortable level, where the retail sales were good enough, where the government, the economy, and unemployment were in a safe enough place, that we would raise them up again. But even though we've had this 10% rally off of the February 11th lows, it's pretty clear that they had been posturing for non-raising the rates today, postponing it till June and perhaps later on, because the state of the economy isn't in that great condition. Okay? Yes, net, we are better off than everyone else in the world, but is our economy healthy? It appears not. Today's commentary, so whether the rally was from February 11th to March 11th, showed a rebound in the economy. It showed a rebound in the market, not necessarily the economy. Did it show a rebound in oil? Yes. Did it show a rebound in anything else about the general health and welfare of this market, of this economy? See, it's a very funny thing. It's really important to know that the state of the market and the state of the economy do not go hand in hand. The market is driven by money coming into the market, okay? By cheap money out there, people getting into the market and fueling it. That's how we got the bailout worked, right? You borrow money for free, you put it into the market rallies, it's self-fulfilled destiny. What happened in Europe last week? Negative interest rates, people being paid to borrow money. The initial response was negative, but the post-response was super positive. Okay? The post-response was super positive. So where do we lead today? Today was March, no anticipated rate increase, and in fact there wasn't. Okay? Not only that, what are we looking for? We're looking for the actual statement by the Fed, then the minutes by Janet Yellen and their guidance, the tone of the statement. It's kind of crazy. Okay? I can analyze this in so many different ways. Market's response was a huge pop right off the bat. A little bit of a sell-off, and net a really positive response to the fact, which to me was news that everybody knew, was that she wasn't going to raise the rates. Perhaps it sounds from the posturing of the commentary that she's not even going to do it in June because the economy isn't that healthy. So what did we see? We saw a broad-based rally. We saw oil rally huge. We saw gold rally huge, and we saw the market rally huge. Okay? That's kind of, that's knee-jerkish, whether that's covering a short or people saying, you know what, we're not raising the rates. You can still borrow 25 mils. And that even though the economy is not healthy, this market is showing signs of being healthy. Divergence, decoupling economy and marketplace. We saw a broad-based rally. Normally you would see a sell-off in gold, a sell-off in oil, and a rally in the market. But we saw a broad-based rally. Basically people grabbing at whatever they could. They want to buy the hard commodity oil, hard commodity gold. They wanted to buy oil, whether that was a short cover, basically taking a bet that we're going higher. And they wanted to buy the market. So net, actually a really good day for the market. Posturing of the economy is basically saying we're not that healthy and we're not raising rates. So we're going to see a lot of analysis overnight of everybody's reaction to what she said, what she did, and analyze all that stuff. That's not that much of an interest to me. All I know is it was a positive response, net across the board. How that pans out tomorrow, I'm not really sure. We have a close of the quarter, first quarter on Friday. A lot's going to be happening. I'm going to pick this up again tomorrow. Love you all later.